People in markets will do silly things and they get in trouble. The pension funds had got themselves into a big jam. Anything that pushed up interest rate rapidly was going to force them into liquidations and make things worse. The gilt market was disturbed because it's a market, and markets can do funny things. The central bank has to say, okay, this is stupid. We've got to intervene and get markets to go early again. They could be sensible. They could just say, look, we'll just set a price and we'll auction as many as you want to buy. That would eliminate a lot of the problems, but that would run counter to the interest rates are set in the market narrative, so they don't do that. They do it the hard way. Generally speaking, most people, when they talk about bond markets, they're projecting their politics onto government bonds.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. A big thank you to all of our supporters so far. At the beginning there, you heard our guest this week, financial consultant and author Brian Romanchuk. And in a moment, we'll be talking to him about the UK's recent pension fund crisis, how it impacted the gilt market and how that impacted the mortgage market. And also we ask, what is a bond vigilante and how do we get rid of them? If you're new to MMT, you can listen to our first 3 episodes for an introduction, but if you want to dive in here, the headline is that currency issuing governments spend by spending new money into existence rather than spending previously taxed or borrowed money. As the currency issuer, the government spends first, and only at that point do the pounds, dollars, yen, or your local equivalent exist for the private sector, that's you and me, to have the money to return to the government in the form of taxes. The government only spends one way, and that's by changing the balances of bank accounts held by commercial banks at the nation's central bank. These accounts are called reserve accounts, and if you're not a bank or a foreign government, you can't have one. So if we don't have reserve accounts, how do we get paid? Well, just to localize it and personalize it, if the UK government pays you £100, it marks up your bank's reserve account at the Bank of England by £100, and your bank marks up your account with them by £100. Both banks do this with keystrokes. No gold coins are hammered into the internet. No one time travels into the future to borrow money from your grandchildren. These are new pounds in the reserve system and new pound-denominated credit in the commercial bank system that didn't exist before the spending took place. And you can listen to our episode 126 for more about that. So given that governments must spend money into existence first for us to be able to pay our taxes with or to buy bonds with, why do they even sell bonds in the first place if they don't need to borrow the money from us? You can listen to our episodes 30 and 31 for more detail, but for the purposes of the following conversation, the answer is that the buying and selling of government bonds is one of the ways central banks maintain their interbank interest rate target. So government bond sales are part of monetary policy rather than fiscal policy. Bondholders are not funding the government in the same way that you'd be funding a private business if you bought shares in it. When government bonds are purchased, it's more appropriate to think of pounds being moved from a current account to a savings account at the Bank of England on behalf of bondholders. And when bondholders are repaid, the pounds are moved back again to the current account. Now, if you're thinking, what's the point of that whole exercise? Then our episode 144 with MMT founder Warren Mosler, entitled "The Natural Rate of Interest is Zero," is the episode for you. So, as much as the press likes to use the phrase bond vigilantes to conjure up the image of financial freedom fighters sliding down bond poles to their bond caves to correct the injustices of out-of-control fiscal policy, the recent meltdown was the result of incompetent fund managers panic-selling bonds to get cash to pay off debts resulting from their own bad bets, which sent the Bank of England sliding down the bailout pole to give them a bailout, except it's called an emergency liquidity facility when the Bank of England does it. So if the cost of living crisis is causing you to worry about your level of liquidity, you know who to call. But you have to be a pension fund. Unfortunately, there's literally no other way for a government that issues its own money to make sure everybody's got enough money. In the following conversation, we touch on what determines currency prices, and for more on that, our episode 145 with Professor John T. Harvey is a perfect companion. You'll also hear us talk about inflation being a complex phenomenon, which it is, but if you're smart enough to know that raising prices raises prices, which is what interest rate hikes do, then I think you can handle that tiny bit of complexity that's eluding most mainstream economists and the Bank of England. So I've linked to our episodes about inflation in the show notes for this episode, where, as ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month or £1 a month, or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. So thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we're delighted to be joined today by financial consultant, author of many titles, and writer for bondeconomics.com, Brian Romanchuk. Thanks for joining us today, Brian.
Hi there, thanks.
Let's get right into it. It's been a turbulent time in UK politics and financial markets, but the big news in MMT is that the actor Hugh Grant recently asked on Twitter, and I'm quoting now, "I'm very intrigued by MMT and reading a book about it." And the book, by the way, is Stephanie Kelton's The Deficit Myth. But anyway, he goes on to write, "But it seems to me that until the markets believe in it, any government will be forced to show old-fashioned fiscal responsibility. Otherwise, government debt crashes, and with it, pension funds, etc. No?" So what would your answer to a talking point like that be, Brian?
Like, there's sort of two markets, and that sort of come up in the UK situation. One is the currency markets, like the pound sterling, and the other is, the gilt market. Although people lump them together, they are two different things. See, the UK, historically, have always had political problems around sterling crises. Sterling was always overvalued, needed to continuously devalue, and had a currency peg, and it was always a political crisis when the devaluations occur. MMT says, let your currency float. So you don't have a peg, you don't have a devaluation. The pound hasn't been pegged against anything since the early 90s when I was there, and actually it was great for me because I was on a Canadian scholarship, and so I got a raise when the pound crashed. But the issue is that the chattering classes, as they be described in the UK, they haven't adapted. The political commentary has never adapted to a floating exchange rate. And if the pound weakens, this is a political crisis. And if you let a currency float, well, it floats. It goes up, it goes down. If we actually look at it, admittedly, I guess there was a U-turn on the mini budget. I believe sterling is actually stronger versus the dollar than when the mini budget happened. But people forgot about that bit. If you have control over inflation, if your domestic inflation isn't that bad, your currency can't get too weak. As long as you have sort of functioning financial markets, eventually people will say, look, the mainly risk assets are too cheap. You can buy British companies cheap at this exchange rate, and sooner or later there'll be capital inflows, and it'll correct. It's a release valve, but it shouldn't be viewed as a crisis. But in practice, the British political classes are very sensitive to it, and that's the problem with the British political class, not the economy per se. But so there's that aspect. But the other one, which is the gilt, it's very limited what can happen in the gilt market. Sooner or later, it's going to get dragged back to what is the central bank going to do with the overnight rate. And once again, it's inflation control. And nothing was really should have been surprising to anyone, because as it was, the UK has issues with it. Inflation is running higher than desired. It's above target. The Bank of England has an inflation target, so they're going to keep raising rates. They want the economy to slow. I mean, there is a debate in MMT, does raising the policy rate, how good is that at slowing the economy and slowing inflation? But that's a side issue. The Bank of England and most people in the markets believe that raising the policy rate will slow the economy and improve inflation. So that's what they're going to do. And they're on that path. And so since they're expected to raise rates, gilt yields should go up.
Why would gilt yields go up again?
If they're only doing what people previously expected, it should have been priced in. Basically, like if you have a 10-year gilt, it should equal the average of the overnight rate over the next 10 years, plus maybe a little bit of a risk premium. So basically, you see, I can either hold cash, which is basically going to earn the overnight rate, hold that for 10 years, or I could buy a 10-year gilt and lock in an interest rate for 10 years. They should give you the same expected return. And so if the path is unchanged, gilt yields could be unchanged, even though they're actually raising the rate because they're just doing what was already priced in. But since the inflation situation seemed to be deteriorating with, looser fiscal policy, the market should have expected more hikes. That's what the markets are pricing. That's the way it's supposed to work. This is fair value. If the markets were orderly, that's how it's supposed to work. And that comes down to MMT. There's an inflation constraint. If you have high inflation, well, look, that's the constraint on policy. The current institutional arrangement is they want to control inflation via higher interest rates. Whether or not that's a good idea, I mean, that's a side debate, but that's how it works, and that's what you expect to happen. That's sort of, if everything went orderly, none of this should have been a surprise. But what happened in the market was the gilt market was disturbed because it's a market, and markets can do funny things. I just saw a tweet. It's by, I hopefully get the name right, but it's Robert Steeman. He was with the Debt Management Office for the UK, which is, I guess, a branch of the UK Treasury. It's a group that goes to conferences. I believe I've met, I sat next to them at one conference years back. Their job is they meet investors, the banks, and they try and judge the demand for, mainly it's the long end, like a 30-year gilt, because there aren't that many institutions that want to buy 30-year bonds. And so they have to basically issue exactly how much people want to buy. I mean, there can be a little bit of speculative trading in it, but eventually it's going to end up in the hands of a pension fund or an insurance fund. And so they have to get the amount they demand correct. They could be sensible. They could just say, look, we'll just set a price and we'll auction as many as you want to buy. And that would eliminate a lot of the problems, but that would run counter to the interest rates are set in the market narrative. So they don't do that. They do it the hard way. So he said today, as Thiemann said today, the Debt Management Office knew there were problems with the pension funds. The pension funds had got themselves into a big jam, and the rising interest rates were causing them issues with liquidity. And anything that pushed up interest rate rapidly was going to force them into liquidations and make things worse. So this was a pension fund problem and how they set up interest rate hedges. I mean, the disorderliness was not really the government's fault, other than it probably should have not exacerbated the situation. The situation was pre-existing. People were talking about it, I believe, in July, but it was slowly burning away. As yields went up, the pension funds, they needed to raise cash for their interest rate hedges. The pension funds themselves are actually making money on net. Their balance sheets were improving because they were getting paper gains on their liabilities, but that's offset against cash going out. Paper gains aren't cash, and so they were running out of cash, and that was causing stress until finally the Bank of England did a very small intervention that sort of calmed things down, and things appeared to be better shape. Although the Bank of England certainly didn't go out of their way to make markets more orderly, and that's sort of another issue. It was a market turbulence, and that could happen almost any time. In any market, people can blow themselves up. Hedge funds, people using leverage can blow themselves up. People in markets will do silly things and they get in trouble. And the central bank has to say, okay, this is stupid. We've got to intervene and get markets to be orderly again. And that's what they did. They didn't go out of their way to say, hey, we've saved the day here, but to a certain extent, it appeared to have worked.
You make it sound that this is something that the Bank of England is used to dealing with, that it should be very prepared to deal with. But here the narrative, as you say, the commentariat, was all about, the economy is collapsing, the government with its policies is collapsing the economy. And there was this narrative going around that the IMF was going to have to bail out the UK, and that the Bank of England had stayed up all night to avoid economic disaster. How much do you believe these assertions?
They were probably up all night, because what tends to happen on these things is that the central banks, they're always trading in the markets because they buy and sell bonds on their balance sheet. So they're always in the market sort of trading. In certain parts of the market, they're in continuous contact. This was the swap market, which is a derivatives market. It's a side bet on where interest rates are going to go. And everyone thought, okay, they added new rules for posting collateral after the financial crisis, and all these problems were supposed to go away. Guess what? They didn't go away. They just created a new problem. And so they were surprised, which is what happened in 2008. A market that they never they didn't interact with blew up, and so they didn't, they were caught flat-footed. It's not really clear who exactly was in trouble, what was going to go wrong. We knew there was pension funds, but there was probably other firms were tied up as well. And they probably all ran to the Bank of England and say, hey, can you help us? And they have an attitude that they want to leave it to the markets. They want to let the markets sort this out. There is a barrier for them to want to step in. They don't want to be trading to try and direct yields on a day-to-day basis. Rapidly rising interest rates are going to be damaging via mortgage rates. UK housing is rather pricey, and so people have pretty large mortgages and they float. So it's rising mortgage rates cause a lot of pain for households. But that's how the Bank of England's interest rate policy is supposed to work, right? So, the only alternative is don't loosen fiscal policy and possibly tighten it to reduce interest rate. But is that necessarily a good thing as well? So the IMF can't do anything. It's a purely UK issue. There's not even, in the financial crisis, you had cross-border financing, and so they had to work, other central banks had to work with the Fed to get US dollars swap lines. But this is 100% a UK domestic issue. So, it had to be solved by the UK.
I was just going to say, because you touched on it just then, Brian, just as a regular person might experience the recent financial market turmoil, when gilt prices went down, commercial rates went up. How does the one lead to the other?
It's just the price up yields down and vice versa. When you buy a gilt, it pays you a fixed coupon. I have no idea what the yields are. Let's say it's 4% because it's a nice round number. If you bought a new one at $100 or £100, I guess, it would give you 4% a year on that. So you're getting a 4% return on your £100 investment. The way it works is that coupon, 4% a year, is fixed. And if the price changes, the return, the yield on it also changes. And so if yields going up means the prices on existing bonds will go down. So anything quoted, like if you go to a bank and say, I want to get a 5-year loan on something, the bank will work by saying, here's the 5-year gilt rate or the swap rate. It'll have a benchmark, and then it'll add a certain amount and say, this is what we're going to charge you. So if the 5-year gilt rate yield goes up, I mean, that's going to push up the swap rate, and that's going to push up what you're going to pay on a 5-year loan.
At university, they teach you this through the pricing equation for bonds and how it's fair. As you say, if the price of the bond goes down, the yield goes up, and then, there's a fair price to be paid for that bond. And the equation sort of outlines what the fair price is, and the interest rate is a big component in that equation. Is that the right way of looking at it?
Yeah, well, basically, the price and the yield are just like for a given bond, you could quote it as a price, you could quote it as a yield, and generally speaking, the most convenient is to use a yield. Like the only time you need to use a price is when bonds are about to default. In a default, you might get 70 cents on the dollar. Like you get a percentage of the face value. At that point, the actual face value of the bond matters. But under normal circumstances, especially for government bonds, you don't really care about the price. The equation just tells you, for this price, this is the corresponding yield.
And can we also have your clarification on whether the commentariat were right in saying that investors were pricing in the potential default from the UK government?
Nobody that I would take seriously say that there was any real risk of a default. I mean, there could have been people saying that, but there were people that I wouldn't look at for bond market commentary. I mean, there are. I mean, there's generally speaking, like when I was working in finance, I mean, the MMTers were maybe the only sort of outside finance that I would pay attention. And Warren Mosler is in finance, like as a firm. It's actually how I met him. But generally speaking, most people, when they talk about bond markets, they're projecting their politics onto government bonds. It's generally, the quality is fairly terrible. The only place you get decent bond market commentary is, what we call the sell side, investment banks, the research aimed at fixed income investors. The chief economists talk about interest rates, but they're also pretty terrible. It's the interest rate strategists that are the ones. None of them were really saying there's not a default. It was disorderly markets. I mean, maybe there's an inflation problem. You can start going, what if you have unsustainable fiscal outlook and that's inflationary and then they could default? But that's sort of a very esoteric debate. The real problem is the inflation. And you could say way in the future, okay, maybe they'll default because of that, but it's not a plausible story. If default was going to happen, it would be very short term. It would show up in short dated bonds, like 1 year and 2 years. Like, let's say you go to, we're going to default and you only get 70 cents for a dollar of face value. Because normally, if you have a 1 year gilt, it doesn't trade very far from par because it's a short maturity bond. But if there's a default, it's completely different. And so you'd have extremely high interest rates for short-dated bond. That wasn't happening. Like if you look at Greece, they defaulted. You had 30% on 1 year bonds. I mean, that's what happens. You get very high interest rates on short-dated bonds because they're not going to pay back their face value, and they actually get hit the worst. They have very high yields. Yeah, if that happened, then you say, yes, that's definitely pricing a default. Other than that, no, it's an inflation problem.
Because that's the country they were comparing us with, Greece.
Yeah, everyone does. But yeah, it really wasn't it. The issue is that the yields are rising across the entire yield at all maturities because they're hiking rates. That's what's supposed to happen. The real dislocations are in the 30 years, the long dated, the pension funds. They needed like 30-year swaps for their liabilities. For a defined benefit pension, they have to make payments. They have actuaries. How long is everyone going to live? How much we promise to give them? And so they can project their cash flows based on the, projected mortality rates. And so they say, we have to make all these payments way off in the future. And, people, can live 30, 40 years after retirement. And so there's all those payments way out in the future. And so they need to match that. Like, they just don't let pension funds do whatever they want with their pot of money. They have to invest it so they can pay those promised pensions. And so they need to match those future cash flows. And so the natural way to do that is to buy a 30-year bond. But it has a lower expected return than using a 30-year swap and investing the money in equities. That would give you a higher expected return. And if you have a higher expected return, it means you need less contributions into the fund. That's why people, they did that. It wasn't crazy. It was a way of reducing the required contributions on the fund, because otherwise it's less attractive. If you say, well, for these benefits, you have to make more contributions. People don't like it as much. So you have a higher expected return, which then allows them to lower the required contributions for a given set of payments. That's why they need 30-year gilts. Insurance is in a similar boat. And maybe some, rich individuals, people who provision for their own retirement, but generally speaking, people don't tend to do that much. There isn't a huge demand for the 30-year. So it's very easy for there to be a dislocation in 30-year gilts and say, well, they can't issue them. Well, so what? Just stop issuing 30-year gilts. I mean, it's very much segmented from the rest of the interest rate market. But people love selling doom and say, oh, the 30-year, well, too bad. I mean, it's eventually they'll find their own level. But it sounds scary. It's like, oh no, the government's going to default. It's just fits a narrative. And so people just take the story and run with it.
Before we move on, and in case he's listening, Hugh Grant followed up by mentioning that at the time of publication of The Deficit Myth, there'd been massive QE for COVID, but still no inflation. I guess he was supposing and saying, yes, government could afford its COVID response because MMT is right about where money comes from. But now what do MMTs have to say about the current inflation? I think that, that's a common talking point that comes up. What are your thoughts on that, Brian?
The MMT inflation story is more complex. Each country has its own problems, right? Inflation is complex. Like, I'm writing a book, primer on inflation. I'm just talking about what is inflation. I might drop the title. I was going to call it What is Inflation? Basic primer, without going into trying to predict it. Maybe relative to other MMTers, I may not be completely in line with them, but my view is that inflation is much harder to predict than people say. Most inflation models work for a while, then they blow up. You can't just say, oh, well, money growth is strong, so inflation goes up. That's a very easy, simple story. People sold that story, but it was wrong. That hasn't stopped them. If they start changing how we define money, they just keep changing the money definition to try and get it to work. Realistically, what are the things causing the inflation problems, which are varying somewhat by country to country? And that's sort of a micro issue. Okay, what do we do about the energy market? What do we do about housing? Rents are a major issue. House prices are. How do we deal with that? Obviously, a tax cut is not what the doctor ordered right now. That didn't really make sense. I don't have any preferred solution myself. On the Canadian side, I think you're stuck with letting it burn itself out.
I guess any reaction that you do in the context of having an MMT style job guarantee where there's a floor under your standard of living, no matter how much politics screws with the economy, it's already a better way of doing it. Even if you rely on monetary tightening to expand the NIBR, the buffer employment ratio, you're still in a better situation to the way we do it now.
Like certainly a job guarantee, with the labor market being tight, it'll come down to what's the wage. This is where you can have a split between, let's say, progressives and other people. If it came in at, let's say, below the current minimum wage, it wouldn't have that much of a macro impact on inflation. To a certain extent, it'd be somewhat neutral. The issue with the job guarantee is the introduction would normally cause a one-time. It's going to cause a restructuring. But once it's in there, if you got an anchor job guarantee wage, that might tend to help. One of the issues is cost of living adjustments, like with pensions and so forth. They have a cost of living adjustment. And you say, well, you sort of have to do that because otherwise, pensioners would be, they'd be getting nothing, right? So it has to be sort of increased over time. But the problem is that it rises the most when inflation's the highest. I mean, my feeling is you almost have to say, look, you got a 2% inflation target, you just make it an automatic 2%. And if inflation's below target, they're doing better. But if it's above target, well, they're doing relatively worse for a period of time. It's, the same thing would happen with the job guarantee. There's still some political issues, but generally speaking, it's giving you a lever that it can allow you to keep some wages sort of under control.
It seems to me that's the case for going, okay, we should start with it being kind of disruptive, above the minimum wage, up to what Bill Mitchell calls a socially inclusive wage, and have that one-time adjustment and then not have it respond to every jump in the CPI. Because like you say, it is the yardstick. It becomes a systemically important price rather than the bank base rate.
As you say, the story that the mainstream gives on inflation is very simple. It's so simple that people sort of easily accept it on the ground, but also that politicians, I feel that they go to a mainstream economist and they say, okay, what do I do about inflation? Well, the answer is clear. Just do this and it'll fix itself. That's a lot more appealing than going potentially to an MMT economist or a heterodox economist who says, well, what do I do about inflation? It's like, well, I don't know, it's complex,
And, give us a dial that we can turn.
Yes, exactly. Give us a button.
Inflation off. And so far, that dial has been interest rate up, inflation down, and, and it's not working, is it?
Yeah, so even though it is complex, I feel like we have to untangle it a little bit to make it workable.
People don't want to be told. I think I said this in recently, but no, we live in a society. People want solutions. They want a simple solution. And they don't want to be told that something is complex. They don't want to be told, oh, you can't do anything about it. And so mainstream, they've got a nice, simple answer. And they just, when things don't work, they just add epicycles to their models. If the prediction is wrong, well, we'll add some, we forgot about this, and let's add some epicycles, and it'll just go back to essentially the same thing. There's not much of an advancement. There's lots of papers, but it still comes down to raise interest rates to slow the economy. I can't say it doesn't work completely, because housing markets are rather important and they are interest rate sensitive. One of the Canadian solutions, if they would have been to tighten lending standards on housing. But this is a very Canada-specific solution. Mortgage finance is regulated here. If your down payment is less than 20%, mortgage insurance is compulsory, and it has to follow the standards set by it's a Crown corporation, the Canada Mortgage and Housing Corporation. And so their lending standards on mortgages largely determine the lending characteristics in the housing market, because houses are now so expensive that any new homeowner, they have to get mortgage insurance. And So they could actually dial down the housing market selectively without changing interest rates. You'd probably get annihilated if you did that, because there's all kinds of real estate brokers wouldn't be mad at you, but it would have been a possibility. So that's sort of one of the issues, is that any more complex solution is going to be country specific.
Bringing it back to the recent market turbulence, that turbulence has caused a lot of people to restart this discourse about bond vigilantes. And I think I want to call this episode something like, what is a bond vigilante and how do we get rid of them? Over to you, Brian.
A famous market commentator in the 80s came up with the phrase, and everyone has used it. I mean,
that was Ed Jardini, by the way.
Yeah. Okay, that's it. Yeah, I couldn't think of the name all the time. Yeah, it's like people in the bond market love it because it makes them sound powerful, and it fits sort of a neoliberal ideology. So it's repeated. It fits. It's something that everyone, like the financial market commentary complex, wants to hear, that, the markets are in charge. Realistically, you could say the bond markets act as inflation vigilantes under the current system, because the central banks react to inflation. You could, you've seen this in Japan, you could have the central bank pegging interest rate, like they peg bond yields. They could do that, but they generally let them float. The central bankers sort of have an idea, where they would like bond yields to go, and it's like, what would be convenient for them? If you're a bond investor, like if the bond yields are floating, you're not worried about what's convenient for what central bankers want. You're out there to make money. You make money fundamentally over the long term by predicting what is the central bank going to do. Keynes had a thing about a beauty contest where you guess what the other people are going to guess. It's not just a question of getting the central bank rate. You got to guess what the other bond investors are going to guess what the central bank rate is. So you get a little bit of silliness, but in the end, it comes down to, if inflation's going to go up, you expect the central bank to hike, and so that's how bonds should be priced, and that's it. And you're not pricing default; you're pricing the path of inflation. Why should the government care? Like the problem the conservative government, they might have come from Oxbridge, but they're not necessarily the brightest people coming out of there, and there's no reason to panic. Say, look, the bond yields went up. Okay, fine, but that's what they're supposed to do. Like, it's literally what's supposed to happen. It's a market. They go up, they go down. Who cares? But they panic, and so Liz Truss is gone. Realistically, the government should care less. It's just a signal. Okay, you're inflationary. Like, under the current system, that's how it works. And the only way to put them out of business is to go to an alternative framework for fighting inflation. You could peg bond yields. That's possible, but that's not compatible with using interest rates to control inflation.
You're not necessarily of the mind that raising rates is adding income via the interest income channel, and so it's not doing what they think it does.
Well, that's true. I'm sort of ambivalent. I know the story. The effects are mixed.
Mixed at best.
Yeah, it's mixed at best. Very rapid interest rates that destabilize the economy will eventually trigger a recession. But that's sort of very different than saying raising by 25 basis points every meeting over a period of years. That's not going to necessarily do that. You can have an environment and it might do nothing. It has to be sort of rapid, destabilizing movements, to a certain extent what you saw in the gilt market, where it causes something to break. To a certain extent, that's what they've actually done. The central banks have panicked, and they are hiking very rapidly. They don't want to say it, but their plan is either A, inflation turns around and then they can stop, or something breaks. Is this a sensible way to run an economy? I don't know, but that's basically it. Mainstream consensus, certainly in financial markets, this is the way things ought to be. So you're fighting against that entrenched view.
I think in your writing, you've kind of said it boils down to, obviously, it creates a justification for austerity and perhaps further privatization of public goods. When you look at British politics, that's how it plays out. Your question that you posit is, will they break the housing market first.
But I mean, there's nothing stopping from doing both. And it was the Reinhardt and Rogoff, but they did stuff on financial crises, and I wasn't a huge fan of it. But anyways, I'm not sure if it was them or similar people, some other mainstream. But one of the arguments is that part of the damage of financial crises was from the austerity movements, because naturally, deficits will blow out when you have a rapid contraction of activity. Your spending goes up a bit, but your tax base collapses, so you have a big deficit. It's an automatic stabilizer, but then everyone panics, like we had after 2008. Everyone panics, and they implement austerity, and the austerity does damage. The conservative strategy for decades is you do a tax cut and you say, oh no, the deficit's really big now. That means we have to cut public service. They've been doing it for decades. But the thing is, could they double down? Like, they could very easily just say, oh no, we've got to get back our credibility. And
it seems to be central bank credibility is where the central bank proves that it can control prices and then vows never to use that power.
Yeah, the story was, I'm not sure how much they've modified it, but that expectations matter. And so they have to control expectations. So basically, the central bank has to strike fear into everyone. I mean, that's what their models say has to happen. It's sort of a nice, convenient myth for central bank researchers to believe in. They found models that tell them the answer they want to hear.
In your writing, Brian, regarding currency prices, I think I've got this right. You write that the best attitude for policymakers to take is one of benign neglect.
Yeah. Most countries don't have much experience with floating exchange rates. The Bretton Woods system blew up in 1973 when they closed the gold window. And then sort of almost everyone was floating, except in Europe, where they kept various exchange rate mechanisms. My favorite being the snake, because it's just such a great name. The snake. It was the snake in the tunnel, I think is where it came from. But and the UK was sort of in there until it was knocked out of the ERM. But it blew up, and then I think there might be another one, and then finally had the exchange rate mechanism, but it just had a great name. Not really a peg, but it was a currency band system. But anyway, Canada, generally speaking, the Canadian dollar moves a lot versus the US dollar. It's generally not a big deal, other than in the early 90s, there was there's a fiscal crisis, but it was a crisis largely among the neoliberals who basically it was an excuse for austerity. So the Canadian dollar moves a lot versus the US dollar, and we have huge trade flows, and you cannot look at, the inflation series and say, hey, look, this is important. It's not detectable. There isn't that much of a pass through. You need the currency to absolutely collapse, or you have a lot of stuff that's imported. Like most of the developed countries are very self-sufficient in the sense that they're food exporters. We have highly subsidized agricultural sectors, and we dump our produce elsewhere. In Canada, well, we obviously import the stuff that we can't grow in our climate. So a lot of the stuff, it's all domestic. So you don't have this huge, shocking pass-through from the currency. There's maybe a few things that are imported. Okay, the price went up. But by and large, it's not a major driver of inflation. Basically, the Bank of Canada, they used to be bugs about the exchange rate. Now, whatever. You don't hear the same level of whining about the Canadian dollar in the Canadian media than you do in the British, like the UK media, about the pound. It's only sort of politically motivated. Like, if someone's a conservative, they don't like Trudeau, and the Canadian dollar falls, well, they blame Trudeau. I mean, there's a little bit of that. But no, the financial markets, like anyone you sort of would take seriously in financial markets, it's not a story that's pressed. Yeah, whatever. It goes up, goes down, whatever. Just look at the chart. So that's what you want to be. You just want to say, look, let it float. It'll come back. A lot of pension funds are investing overseas. You just have a lot of local investors. They'll say, look, the Canadian dollar gets cheap. They'll sell their U.S. or European assets and buy Canadian ones. My first company that I worked for didn't have a pension plan, so I managed my own retirement. Like it was a self-directed, and so I have my own fund. funds. And, to a certain extent, I would do that. Like, I basically will go back and forth depending on what the Canadian dollar is doing. Canadian dollar is expensive. Okay, go overseas. If it's cheap, okay, I'll bring the money back. And, I'm not moving the currency market by myself, but, there are big funds out there, and that's what they're going to do. So it floats, you let it float, and it's not really a problem.
I think you're absolutely right there. I think for some reason, the Brits derive quite a lot of pride from the pound. And I think that played a role as well in the 1970s IMF crisis, that the government didn't want to devalue the currency and all that. But it is strange because obviously you see other countries purposely trying to keep the value of their currency low relative to other currencies. But for some reason that here is perceived as a kind of condemnation of the British economy as a whole.
Yeah, I think even Switzerland pretty recently they had a peg, but it was a peg to stop it strengthening, basically, to stop the Swiss franc strengthening.
Yeah, exactly.
I mean, this is part of the post-Keynesian MMT divide. MMT is yay for free-floating currencies. And the post-Keynesians, they want to bring back like a new Bretton Woods, come up with a new global currency peg system. So, that's a little bit of an incompatibility that shows up in the various disputes that you see.
I think the main problem that the MMTs have is, well, if you do that, then you're giving up your ability to use fiscal policy in a positive way to shape your economy.
And also, you could answer that by going, okay, you like currency pegs. Well, we're proposing the labour standard. That's what the job guarantee is. We're pegging the value of the currency to the price of labour at the minimum. And there you go. It's going to be internally stable to that standard.
The post-Keynesians that I end up getting in arguments with, they're very much, in terms of capital controls and currency management. They're into the whole currency and bond vigilante story.
So just to sum up the bond vigilante story then, and I think I've probably got this from something you retweeted, Brian, which is there is only one bond vigilante that counts, and that's the central bank.
Yeah.
If we recognize that, we can get rid of all the other bond vigilantes. It seems to me the Japanese yield curve control works. Politically, it's a long way from where we are now, but the crisis that we're at in the UK at the moment, somebody's going to have to work this out. Something's got to give. I mean, usually, what we do is we go, okay, the weakest in society are going to have to bear the brunt of this. We're going to do cutbacks. But sooner or later, somebody might work out that the central banks have gotten too political. Let's have yield curve control, zero interest rate policy, and guarantee people a decent job.
Yeah. I mean, certainly, like the yield curve control, I mean, you have to give up on interest rate inflation fighting. And that you're running into the entire conventional economist complex. That's a huge fight against literally every other economist in the room. Maybe you can win it, but I'm going to say it's not an easy fight. It's going to be a challenge.
I guess it'd be interesting to unpack how Japan got around that conundrum then.
They've had zero rates now since the mid-90s. And they haven't had an inflation problem, but they haven't needed to raise interest rates, so they don't care. And that's it. But see, if they wanted to use if they wanted to raise interest rates, then they have a problem. Because then they have to get out.
That's the next thing to watch for, I guess.
Yeah, well, I mean, waiting for inflation in Japan is going to be slow. I covered Japan in the early 2000s and had to deal with people expecting Japanese inflation to take off in months. Yeah, so it's, but yeah, like it's a big fight, but like it's not a trivial change. Like QE, quantitative easing, it was a change of procedures that they were able to do and bring it in. And it didn't really affect things too much. So it's something that could be implemented by a central bank and nobody really cared. But losing interest rate control would be a big fight. And there's no... It's sort of a different, there's some things that, you could maybe do differently. Like they can say, look, we should create an agency that looks at the inflationary consequence of fiscal policy. It'd be a fight, but you could get that done.
maybe we should set up an agency for overseeing monetary policy operations and their impact.
Yeah, I mean, certainly the problem with the Bank of England, I mean, it did seem politically motivating. I mean, you could say he's doing what he's supposed to do, watch inflation, but he's also got to keep an orderly market in gilts and should not be playing politics. So I think it's Bailey, right? Knuckles should be wrapped over that. Like they have an interest rate policy, but they also have to ensure orderly functioning of the gilt market, because otherwise interest rate policy isn't going to work properly.
Which is probably what Truss and Kwarteng may have naively banked on when they went, look, yeah, we're going to tell you later where the money's going to come from. We're doing this now. We're doing these tax cuts now. We've got this window to act aggressively. Yeah, I think it was Andrew Bailey who just, stood against that quite publicly, and it cost them their jobs.
My feeling is that they were sort of an ideological fringe. I mean, I ran into Thatcherites in the 90s, and even other conservatives thought they were loons. Advancement was dependent on your purity to the ideology, and not having, common sense didn't come into it. I think that's what happened. I don't know if they had a plan. It wasn't going to work. Bailey, they should have just said, look, whatever it takes, putting that stupid, everything has to be sorted by Friday. Just saying, look, it's open-ended. No one actually took up. It was like less than $5 billion in gilts that, when I heard, maybe it expanded, but like a few days in, it was less than $5 billion gilts bought, which is, it might sound like a lot of money, but that's peanuts for the Bank of England. Size their balance sheet, it was inflexible and stupid. If they're independent, they got to stay out of politics.
While we're on central banking still, MMT takes the endogenous money view, the view that banks aren't lending out depositors money, rather they're creating new deposits when they lend. So when the recent Swedish Central Banker Prize in Economic Sciences tried to showcase the work of their most recent prize winners, they tweeted a graphic that seemed to show a commercial bank as an institution that takes in people's savings, then allocates those savings to businesses. And lots of people, me included, found that a bit funny. But you've got a slightly finessed view, which you wrote about. You wrote, kind of, just to paraphrase, you wrote that, yes, intermediation in terms of bank credit being passed from savers to borrowers doesn't happen, but the banks act as credit risk intermediaries. What do you mean by that?
I thought that Nobel was a bit silly, but the problem sort of with the mainstream is, like, from their models, basically you're swapping back and forth stuff that already exists. And you say, until both of you end up happier. That's the bottom of the framework. And money is just one of those stuff that you trade back and forth. So it's very hard to deal with credit. I can lend you $5 and then boom, you give me an IOU. And the IOU is a new financial asset that pops out of nowhere. It's not like a lump of gold, that you're reallocating among people, which is what the models would like. And so, but when you look at a loan, if customers are worried about the credit quality of a bank, it's not going to be a bank for more than a couple of days. Banks have to be the most liquid, most creditworthy entities in the system, or else they're an ex-bank. So what's happening is that they're taking credit risk in their loans, and I'm not taking any. And so that is where, there's an intermediary.
So that they're not passing credit risk between customers.
Yeah, they're absorbing the credit risk on their loan book, so you don't have to.
The way I've often thought of it, and you tell me if this is too much of an oversimplification, but you could think of your promise to pay £500 in the future as a £500 note, but it's not very liquid because people don't know if you're going to default on it. So you take it to the bank and they launder it. The bank look at you as a risk, like you say, Brian, and go, yeah, all right, we'll swap your IOU that's got some default risk to it for one of our IOUs, which has got zero default risk to it, because we don't get to be a bank unless the government's standing behind us, ready to step in if you go south. Does that sound fair enough?
Even in a situation, because we haven't always had deposit insurance, and in the past banks did, were affected by runs and stuff. Even in that situation, it's still a diminished risk.
Yeah, it's going to be diminished because, they've got the equity, they're regulated, and, they're designed to absorb credit risk. They're presenting customers with safe instruments, and they're taking the riskier one. That's their economic role. It'd be very easy. If credit risk didn't exist, money supply could go off to infinity very easily because everyone would just be issuing stuff. Lending hits the maximum because of credit risk. It's not the actual, oh my gosh, we have to wait for someone to show up, with $100 bills so we can loan it out. The loans are created. The instruments just appear out of thin air, and boom, the thing that says, well, we can't do this forever. You can't do it forever because someone is taking the credit risk on all those loans.
So, yeah, commercial banks are risk laundromats.
Yeah, basically, that's it. And that's the thing. The models have a hard time dealing with that. See, they can sort of handle the idea of money moving around, but credit risk doesn't fit in the framework.
Well, this has been a great chat, Brian. Thanks for your time. Looking to the future, do you have any more books in the pipeline? I know you mentioned one earlier, or anything our listeners should be looking out for?
Yeah, I've got 2 books in the pipeline because I've been naughty. I had an inflation primer that I wasn't hugely satisfied with, and I sort of put it on the back burner. It might have been 90% done, but my feeling was I wanted to wait for inflation to subside. This is the only interesting inflation episode since the 80s. So, I guess I might as well wait so I have a bit more clarity, and I'm starting to do that. So I don't know when that would be done. Realistically speaking, it would be early 2023. And the other one I started was on banking from an economic point of view, like not how to be a bank investor, but how do banks fit in with the macroeconomy. That one, the earliest I would guess is the end of 2023.
I think that's a great place to leave it. We've been speaking with financial consultant and writer for bondeconomics.com, Brian Romanchuk, and we'll link to where you can stay current with his work in the show notes for this episode. But for now, thanks so much for joining us once again today on the MMT podcast, Brian Romanchuk.
Thanks.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.